Market manipulation comes in many shapes and sizes, but it always has the same victim: you, the retail investor. And we've talked about it on this channel before, and guess what? It's still going on. And as long as the crypto markets are being manipulated, we're going to keep talking about it.
Keep talking.
And that's why today we're breaking down some of the most pervasive forms of manipulation in crypto, and how you can spot these practices and stay one step ahead of the tricksters. Lock in. So, who is manipulating the crypto markets? Well, like most things in life, a small group controls the levers of power, and they are not retail investors like you and I. And if you are thinking of crypto whales, you're on the right track. By definition, whales control so much crypto, their actions can move markets. However, a big portfolio maketh not a market manipulator. And most whales are just like us, but with more crypto. It's really a specific subset who you need to be concerned about. They are the so-called smart money. This is just a flattering term for institutional players like venture capitalists, exchanges, market makers, and institutional investors, plus a very small number of elite traders. Now, if they're the smart money, then what do you think that makes us? Charming, isn't it? The problem is, they know exactly how we work, and most of us have no idea how they work. And they use this to their great advantage. One thing that separates us from them is that we are discretionary traders. This means we make decisions based on our own judgment, experience, and analysis of the market. Inevitably, there is a huge emotional component to this, namely fear and greed, two of the most powerful drivers of human behavior. Moreover, we often rely on the same indicators and technical analysis to make our decisions. Buy when the RSI is low, sell when it's high, place your stop losses a little below support or a little above resistance, and so on and so on. All of this makes us quite predictable. Smart money studies these patterns and invests billions of dollars into algorithmic trading systems to exploit them. Rather than relying on discretionary trading, their systems use mathematical models and predefined criteria such as price, timing, and quantity. And needless to say, these systems are FUD and FOMO proof. Most algorithms work on a breakout strategy. When price surpasses key levels, there is typically an influx of buy and sell orders. The algorithm then executes trades here to capture liquidity concentrated in these particular areas. To smart money, liquidity is paramount. They typically handle enormous positions and want to enter and exit with the least slippage possible. To do this, they constantly target key price levels where other traders' orders are concentrated. In the case of exchanges and market makers, they can see exactly where your orders are placed, which is just like playing on easy mode, so to speak. Yes, a newsflash. Some exchanges have been known to trade against their customers. Market manipulation comes into play when smart money intentionally pushes prices up or down to reach these key levels and grab the liquidity. The more liquidity they take, the more potential profits they can make. And if you're a seasoned trader, you'll know this all too well. This manipulation appears in candlestick charts as long wicks, specifically the so-called scam wicks or stop hunts. These wicks appear when a crypto is trading within a range and then abruptly breaks well outside of it before returning, usually on lower time frames. This is an unnatural price movement, and it's usually no accident. Instead, someone placed a large buy or sell order to violently force the price up or down. In some cases, these large orders aren't even real. To learn how that works, you can check out this video over here where we explain the concept of spoofing.
Hey everyone, sorry to interrupt the video, but I just want to very quickly tell you about the Coin Bureau deals page. This is the place where we put together all the amazing deals and promos that we're able to offer you guys exclusively as viewers of this channel. Head on over and you will find such things as discounts on hardware wallets, some seriously impressive trading fee discounts on some of the best exchanges, as well as some frankly mind-boggling sign-up bonuses for some of those exchanges too. The link is down below. Check it out when you have a moment. Thank me later. And now, back to the video.
At any rate, smart money players throw their weight around with the intention of pushing prices up or down. And by doing this, they can trigger the liquidation of other traders' positions. And of course, one liquidation can trigger another, causing a cascading effect that pushes prices further in the direction intended by the smart money player. The result is that these manipulators can fill their own large orders at a discount or premium to the fair price that an asset is being traded at. The less liquid an asset is, the more easily its price can be manipulated. An illiquid market will have a very thin order book, meaning that there is a wide spread. The spread here, of course, means the difference between the prices sellers are asking for and the price buyers are trying to bid at. Wide spreads can result in wild price swings, and this makes these markets ripe for exploitation by whoever has enough crypto and cunning to pump or dump the price on purpose. Another thing worth noting is that many large institutions buy and sell crypto OTC, specifically to avoid having this kind of impact on the publicly traded markets. And in light of this, those players who do execute their massive trades on exchanges with a single dump and trigger mass liquidations are almost certainly doing so on purpose. So, how can we avoid falling prey to these tactics? Well, the first step is to accept that no, you are not paranoid. The market really does move as though someone is trying to screw over as many people as possible. The more you understand how manipulated these markets are, the better your risk management is likely to be. If you trade in futures, keeping your stop loss well away from your liquidation price is the bare minimum. Beyond this, you should consider whether your stops are placed at a predictable level where other traders are likely to have placed theirs. The more orders that are concentrated in a particular spot, the greater the incentive for smart money to go hunting for all of you. In general, you should keep an eye on higher time frames. And this goes for both spot and derivatives markets, and it's because long-term trends are more likely to reflect genuine supply and demand than short-term action, which may be noisy and more easily manipulated. Let me put it this way. Which do you think is easier to manipulate? A weekly candle or a 15-minute candle? You see, trading on lower time frames generally means betting on smaller price movements. And the smaller the move needed to manipulate or liquidate you, the easier it will be for smart money to do so. Now, we've discussed price manipulation by smart money at a high level here, but different types of institutions manipulate the market in different ways. And there are many forms of manipulation, but today I want to talk about one of the most egregious kinds. The listing day scam wick. So, what's this all about? Well, if you've ever witnessed a newly listed crypto opening for trading on a centralized exchange, you'll know that it's utter chaos. The price always seems to skyrocket before coming crashing down to earth and then eventually stabilizing. For anyone trying to buy or sell when trading opens, the volatility can make the whole thing feel like a pump and dump scheme. In some cases, the listing itself is apparently such a big deal that the crypto in question immediately makes a new all-time high. But what can you do? I mean, all this volatility is just excited buyers scrambling over a shiny new listing, right? Well, yes, but that's not the whole story. Exchanges tend to list cryptos at a discount to their market price, where one is available. And this guarantees there is a ton of real demand when trading does start. Conversely, if the crypto is making its public market debut, then it's usually marked up versus what private market investors paid. And this doesn't matter though, because private market prices aren't publicly known. In any case, when trading opens, there is always a massive green candle. And if the crypto had a previous market price, the listing pump leaves it in the dust. So, you open your exchange app and what do you see? Another new listing is mooning like crazy. Well, who knows how high this thing could go? I might as well try and hitch a ride to the moon too. And off we go, like moths to a flame. But wait a second. Aren't exchanges supposed to have enough liquidity to stop prices from going completely haywire? Isn't that their whole appeal? And why are new listings so volatile? Is there really that much demand every time a new crypto is listed, like even after it's way above the market price? Well, the answer to all of this lies with market makers. If you aren't familiar, market makers are companies who are retained by exchanges or by crypto projects to provide liquidity. Their job is to continuously fill the exchange's order books with buy and sell orders to facilitate trades at any price point. In effect, they fill in the gaps between organic buy and sell orders placed by users of that exchange. And this creates a narrow spread in the order book, thereby minimizing slippage and providing an efficient trading environment for all. Make no mistake, this is a really important role. We need the liquidity they provide. Unfortunately, the nature of their role gives market makers a great ability to manipulate prices. So, how do they handle new listings? Well, when a project is to be listed on an exchange, it will often loan a large portion of its supply to a market maker. And traders need to be able to buy and sell this crypto the moment it is listed on the exchange. And to make this possible, market makers fill the pre-market order book with buy and sell orders. And this is where the manipulation can begin. For cryptos that have publicly available price data, a responsible market maker would fill the pre-market order book with plenty of orders in the region of the current market price. Even if the crypto begins trading at a discount, the order book should have enough liquidity for price to stabilize at the actual market price. After all, arbitrage trading guarantees that price discrepancies will eventually be ironed out. However, market makers often choose not to do so and instead deliberately undercapitalize the pre-market order book. Instead of concentrating orders around the actual market price, liquidity is spread very thinly, creating a wide spread in the order book. The result is that when trading opens, prices shoot up as buy orders melt through the sparse sell orders on the book. And once the price is high enough, the market maker aggressively shorts the token with a wall of sell orders that absorbs demand and dumps the price. Here is an example of what that looks like. Now, earlier this year, Bitensa's Tau token was listed on a major exchange, and it immediately rocketed to $1,250, setting a new all-time high far above the market price on any other exchange. This kind of price action severely disrupts market structure and can lead to an extended period of down-only price action thereafter. Of course, not all market makers behave in this way, but there seems to be little accountability for those that do. An analysis published by Cointelegraph studied 93 listings on major exchanges since April 2024 and found that 78% of them followed this manipulative model that I just described. The author categorized 70% of these listings as, quote, parasitic, and found that they resulted in, quote, a 420% increase in market volatility, pointing to severe undersupply and inflated prices that lead to market abandonment. For crypto projects, listings on major exchanges are typically thought to be a bullish catalyst and a major milestone in the project's growth. And of course, unscrupulous market makers know this, and this bullish listing narrative provides them the cover to have an absolute field day. By creating artificial scarcity on the order book, they guarantee a big pump upon listing. And this is self-perpetuating, as the pump causes more unwitting buyers to FOMO in, bidding the price up to unsustainable levels before the market makers dump on them all. It's an illusion of massive demand, when in fact, it's more a case of supply being withheld, and perversely in exactly the place where liquidity is supposed to be the deepest, preventing this kind of volatility. Unfortunately, market makers aren't accountable to us. We aren't their customers. However, we can both protect ourselves and protest by sitting out listing day on centralized exchanges. If enough people know what they're doing, one day they might stop getting away with it. The last kind of manipulation I want to talk about is fugazi volume. Sus trading volume alone can't tell you everything, but it can provide confluence if you think that something abnormal is going on with a crypto's price. For example, abrupt spikes in volume that have no apparent catalyst could be someone attempting to manipulate its price. Conversely, abnormally uniform trading volume is a telltale sign of unsophisticated wash trading. Wash trading is essentially astroturfed volume. In other words, someone is trading with themselves to mislead others into thinking that there is more trading volume than there actually is. Wash trading has two kinds of perpetrators. Firstly, you've got the centralized exchanges. They need volume to attract users and improve their rankings on sites like CoinMarketCap and CoinGecko. And then secondly, you've got the crypto projects. They need volume to give the impression that the market cares enough about their token to trade it. Then there's the double whammy. Some exchanges have unwritten rules that a crypto must maintain a certain level of trading volume, firstly, to get listed, and then secondly, to avoid getting delisted. And this can lead to a project insiders wash trading their own crypto on an exchange where the exchange is already doing wash trading anyway. That's a whole lot of washing, so why does this feel so dirty? Unfortunately, wash trading is rampant on both centralized and decentralized exchanges. A 2022 paper by the National Bureau of Economic Research studied 29 unregulated centralized exchanges and concluded that on average, more than 70% of their volume was wash trading. And among 12 Tier 2 exchanges, it was closer to 80%. So, why should you care about wash trading? Well, have you ever seen The Truman Show? Do you want to trade an asset where you have no idea how much of the trading volume is real? What if it's just you trading all alone in a sea of wallets controlled by project insiders? It doesn't sound like a promising investment, nor a good trade in the making. The good news is wash trading is sometimes easy to spot. Let's compare a couple of markets to see what I mean. We'll start with the BTC USDT pair on Binance. Now, Binance is the biggest crypto exchange and BTC is the biggest cryptocurrency. There is a ton of liquidity and genuine trading activity concentrated here. Neither Satoshi or Binance have any need to fake trading activity because there is plenty. And this is what the volume looks like. It's all over the place. And as far as we can tell, this is about as organic as you can get. Now, this is not to say that wash trading couldn't happen on this exchange, nor that smart money can't manipulate the price of BTC. But a market this big is not manipulable in exactly the same way or to the same degree that smaller and less liquid markets are. For comparison, here is an unnamed crypto on a smaller centralized exchange. The volume is highly uniform, with buying and selling apparently in equilibrium for a long period of time. Of course, you can't expect this chart to look the same as BTC, but the principle still stands. Real trading volume tends to fluctuate and certainly doesn't look like this. This is the most unsophisticated kind of wash trading because they don't even bother to make it look like organic activity. Insiders with nothing better to do are basically playing a game of buy and sell ping pong to hide the fact that nobody is trading the token. And this happens on decentralized exchanges too. Here we have an unnamed meme coin, and looking at the volume, it appears to fluctuate more than the last chart. On the other hand, the volume never seems to fall below a minimum threshold. Well, since this is Dex Screener, you can see these transactions as they actually come in. At first glance, there appears to be some of the randomness you would expect with real trading. But on closer inspection, it's the same few wallets making similar transactions on arbitrary sums at regular intervals. These are bots playing the same old game of ping pong, but at least this time they make transactions of different sizes to make it a little less obvious. So, if you don't like being deceived, keep an eye out for patterns in trading volume that may be suspicious. And if you're using a decentralized exchange, use a tool like Dex Screener to check out the transactions. You might see the same wallets making similar transactions all day long. Not very realistic, is it? If all this chicanery has got you feeling down on crypto, don't worry. Every financial market in the world is subject to some kind of manipulation, from the highly regulated forex market to stocks and crypto. We're all in the same boat. It's the institutions who control 99% of the resources and spend all day, every day, trying to fleece us little people out of the 1% of crumbs that are left. The good thing about crypto, though, is that everything that happens on-chain is public. The manipulation is often done in broad daylight, so at least you can be sure of what's going on. When it comes to centralized exchanges, well, some are worse than others, and if one of them gives you a bad vibe, you can boycott it. Self-custody is always the end goal anyway. Remember, knowledge is power, and the more you know, well, who's going to call you dumb money when you know all the tricks in the book? The order book, that is. Anyway, there's another reason to subscribe to the Coin Bureau and turn on your bell notifications too, so you can stay informed and 2 steps ahead of those who want to deceive you in the crypto market. And if you got something out of this video, go ahead and smash the like button too. Go on, there's no gas fee or anything required. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, signing off.